if you look at your Rolodex of people you should know two other purely passive accredited investors and have them good buddies to you to bounce ideas off of for every one operator. Most people, they have it the opposite way, right? Where they know 25 operators, but they have no friends, right? Or like less than a few passive investor buddies. Should be the opposite, in my opinion.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Get ready for the Midwest Real Estate Investor Conference in Grand Rapids, Michigan. Join hundreds of real estate investors for networking, learning, and growth. Be sure to mark your calendars for April 24th and 25th of 2025. Hello and welcome to episode 468. When Lane Kawaoka was last on the show, it was shortly before he left his day job as a licensed professional civil and industrial engineer. Since then, Lane has gone on to found the Wealth Elevator and owns 10,000 rental units through his investor club, which has acquired over $2 billion worth of real estate by syndicating $200 million of private equity since 2016. Lane also hosts the highly rated podcast called The Wealth Elevator. And today, he's going to share the 5 floors of the Wealth Elevator with us. Lane, welcome back to the show.
Good seeing you, Brian, again. It's been quite a while.
Last time we talked, you were still working a full-time job. And since then, you've done billions of dollars worth of acquisitions, raised hundreds of millions of dollars from private money and investors. How did you get from full-time job to where you are now?
2009, I bought my first house to live in, then started to rent it out. And then several years later, 2015, I had about 11 of those little rental properties scattered throughout the country. And about this time, I started the Wealth Elevator podcast, which, 470 something, you and I are kind of going back on what that number was. I'm actually around that same number too. So that was, and then started to build a community of, people buying little remote rental properties. And then obviously it moves to syndications and private placements once you become an accredited investor. And I think prior to you and I talking in 2018 or 19, I had already started to, invest as a passive investor in syndications and also like syndicating, my own deals after having, not the best of luck when you first get started, with the quality of operators when you jump in on that ground floor. And I think when we talked, I had probably done a bunch of deals, but yeah, it was about time where I had kind of proof of concept. And, I was kind of conflicted because I had all these rental properties and I was already starting to invest in larger deals as a passive. And I was like, well, this would have been a kind of a nice gig, just to kind of hide out as an engineer and, pretty easy job. Not going to lie, where I probably, you say full-time job, but I probably work maybe 5 to 10 hours a week and then, hang out and do real estate stuff on the side. But, from a bandwidth issue, it just became like I had to just, quit and, spend all my time doing the real estate syndication, type of stuff. And yeah, 2020, we went over $1 billion of assets. I think, that was the pandemic year where some operators pulled back and we got that wave, right? And people don't know the wave. It's when, you're starting out, you got like a couple of years under your belt and the brokers are now starting to recognize you and feed you deals. And that was, when we hit it. And now over $2 billion of deals now. Of course, headwinds with the recent, correction of commercial real estate down 20 to 30%. That's been a bit of pain for sure. But here we are today, still alive, right?
And you wrote a book recently called The Wealth Elevator. Why don't you tell us about that? And I know you're going to take us through the 5 pillars.
This book is mainly written for accredited investors. There's a lot of books written out there for, the masses, like the Susie Ormans, the Dave Ramseys, folks in debt. And even the Rich Dad Poor Dad, right? Like the Rich Dad Poor Dad, I think great book, but a lot of it is just predicated on like mindset and kind of understanding the different quadrants and investor versus business versus W-2 employee. What I wanted to create was kind of a stepwise formula of going through these different floors of the wealth elevator. And I kind of, defined 5 of them because these are the same things I did. Right? I always try to experience share. I don't give advice. I just tell it from my side of the story. And as somebody, an engineer who, graduated, got a job, I didn't start in the basement level. The basement level was folks under $50,000 annual income, you're less than $250,000 net worth or in debt, right? This is where all the Susie Orman, the personal finance blogs come in. I started on this first floor where you would buy rental properties. It takes a while, right? I did this from 2009 to 2015, but you get your net worth to accredited investor status.
And what is accredited investor status?
I believe that's $200,000 a year of income. Now, I don't know if that means like your rental property is included in that. I don't see why not. Or you can also qualify from a net worth standpoint, which is $1 million net worth, not including your primary residence. Although I suppose you could just get a HELOC or a loan. So I don't really understand that one totally. It's not like you take a test or anything. You just, most times self-certify, or you can get a third party letter from your CPA or attorney. And once you get that, supposedly you're entered into this world of, accredited only deals, 506C opportunities. But in reality, you're kind of in this world too. Most of the deals done are 506B opportunities, which technically you don't need to be an accredited investor. We just have to be sophisticated and within the personal network of the general partner, operator, syndicator.
It helps to be an accredited investor. And I think that, the key takeaway from that is that accredited investors get to do deals and get to see deals that normal people, the average person, never even is aware of.
I think it's more like if you're thinking of the iceberg analogy, the tip of the iceberg that's out of the water, that is the less part of the iceberg, is like the 506C deals. Now you're seeing all these deals out there. I wouldn't say they're necessarily better. It's just the operator has opted to generally solicit the offering, talk about it on podcasts, YouTube, or, meta ad. And at that point, they have to only accept accredited investors. But really, the bottom of the iceberg, the majority of them are those 506B offerings, which is supposedly back in the day was for friends and family.
These are typically real estate or business type investments, not stocks, bonds, or mutual funds, but like private offerings. And the 506B that you're talking about, you don't have to be an accredited investor. You just have to be sophisticated and have enough experience so that you know what you're getting into.
Not a lawyer, but that's the furthest extent of my understanding of this.
You can look it up and verify what we're saying.
Now you're getting into this world of like country club deals. I guess nobody really goes to the country club these days because who's got the time? But this is when the wealthy people would get together and do these better deals, and this is how they got off of Wall Street products and into these more alternative, more direct investments into things such as real estate. But this is in 2016, my eyes were opened to this world because prior to that, I was not an accredited investor. My parents were not accredited investors. I didn't have any accredited investors in my network. I didn't have a rich uncle. And I was just some kid in my late 20s who had 11 rental properties. And then I started to interact with all these accredited investors, right? People that were, a decade or two, in years beyond me. And certainly, a million, few $1 million net worth more than I at the time. Certainly the pedigree I wanted to follow. And this is where the steps that I put in the book, of all these paradigms that you go through. The first floor of the wealth elevator, buying rental properties. And then this was the second floor of the wealth elevator that I transcended into, where, maybe you've got some rental properties already. You're realizing that they're just not scalable. You've got high liability. You're the person on the front lines to get a lawsuit, especially the frivolous lawsuits. And, you're trying to scale up. And this is sort of where I met a lot of accredited investors, and a lot of them were doing the same thing. They're dumping their single family homes, selling them. It was great at the time, but moving more into these syndications and private placements and, scaling and getting multiple deals, dozens and dozens of deals. Like today I've got maybe just did my taxes about 95 K1s this year. I'm not saying that that's a diversification. I certainly think diversification is more over a certain timeline of 4 to 7 years, because that's how a market cycle is typically. But that's kind of that next layer that I kind of discovered.
With all those K1s, Lane, and K1s are basically your tax reporting for each individual syndication. Are those deals that you're invested in as an investor, or are they deals that you're involved in as a sponsor?
I believe most of them are where I'm a general partner. I mean, I'm an operator, sponsor, and I think early on, I didn't really trust people too much. So I kind of hit that divide. I was like, well, you know what? I'm younger. I got some interest in this. I'm going to go down the general partner route. So because of that, that was a long time ago, 2016, I made that decision. Today, most of my holdings are my own home cooking, where I'm an operator in. But I definitely like to diversify into different asset classes out there that I'm not really an expert in. Now I even, as my peer group expands and, kind of talk about this in, the second, third, and penthouse level of the wealth elevator, you start to branch out into different asset classes, more asymmetric investing in a way. Asymmetric means like, more risk, more reward, right? Real estate, traditionally, if you're going in with fixed debt, 5-6 year terms and greater, it's pretty stable. It's a hard asset and you get great tax benefits. But as this is more recent, right? And if you're not yet to $4 or $5 million net worth, maybe just put it into the back of the pocket or buy my book, right, to read the section later. But you eventually drift off to other more private equity offering, buying businesses, right, where it's not associated with real estate. They might do the business in a real estate building, but it's there's not really any hard asset, but it is much more potential to grow it. I think, if you take multifamily value add, right? All you're trying to do in some of those cosmetic renovation type of projects, new flooring, appliances, paint job, some new playground equipment, is to bump the NOI, the net operating income, by 10 to 20%. And that's enough to double investors' money in that, right? Because you're leveraged, 3-4x. But in businesses, you have the opportunity to maybe even 100%, 200%, that not the NOI. In this world, you call it EBITDA. It's kind of the same thing, right? Income minus expenses. But you can, much, much more, get a much higher multiple in terms of your investment dollars, even without leverage that you get with real estate.
First floor is really investing yourself, buying some single families or maybe a multifamily, but doing it yourself. The second floor is investing in with other people and other people's opportunities as an accredited investor. And then the third floor is branching out and diversifying, not just into real estate, but also into other types of businesses. Am I following you so far?
Yeah, and I think when most people get started on that second floor of the wealth elevator, when you're first starting to get into the syndicated world, people tend, and myself included, we tend to pick individual deals, like single asset LLC projects, right, where you know what building you're buying. I think one subtle difference when you start to get into that third floor and higher is you start to go into more diversified funds. Normally funds, I'm not a huge fan of, especially like the deals with 5, 10, 20 apartment buildings, because typically, I mean, I'm a fund manager, so I know you have a lot of inefficient use of capital in those arrangements.
Talk about the difference though between a fund and a single asset syndication, just so people can follow what you're talking about when you say fund.
So single asset syndication is like you have one building, one asset you're going after. Like we are investing in 123 Main Street in, Huntsville, Alabama, right? And this is the asset. And investors can say like, yeah, I like the market. I like the business plan. And also I think investors in this stage, these are the people transitioning up from single family home ownership. They have that sense of pride of ownership, right? They like to maybe brag to their friends that they own this building or that building, even though these are kind of boring assets in a way. But on the other side of the spectrum, you have funds, and the scope of a fund or prospectus can range very widely, right? It could be 5 properties, it could be 100 plus properties, right? It's all in the prospectus, and it could range from very widely. Oh, it's good deals, super, just making that up, right? Or it can be like, all right, we're going after tertiary markets where there is not a lot of new supply coming online, because a lot of new supply coming online in primary and secondary markets right now with fixed long-term debt greater than 7 years, right? That's a prospectus. And then in the middle, and what I've done maybe a few times is, you kind of a hybrid model where it might just be a 2-pack or a 3-pack. I think that's the best of both worlds. But it's all, this is all personal preference, I think, and I think this is where investors need to interact with more purely passive investors than talking to operators all day long. I have kind of this loose rule where if you look at your Rolodex of people, you should know 2 other purely passive accredited investors and have them good buddies to you to bounce ideas off of for every 1 operator. Most people, they have it the opposite way, right? Where they know 25 operators, but they have no friends, right? Or like less than a few passive investor buddies. Should be the opposite, in my opinion.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Save the date for the Midwest Real Estate Investor Conference happening April 24th and 25th of 2025 in Grand Rapids, Michigan. This event is the perfect place to connect with fellow real estate investors, gain valuable insights, and elevate your real estate game. With a lineup of expert speakers and numerous networking opportunities, you won't want to miss it. Good to compare notes on passive investment opportunities and operators so that you know what you're getting into.
Yeah, but in a case like this, probably you and I could probably go back and forth on what do you prefer and why. But then I may not agree with you, you may not agree with me, but brings up certain points, right? And there is no perfect asset allocation mix in our world. If you think there is, you belong in the world of Vanguards and Fidelities, right? This is the alternative investment world. There is no normal. So, but that's something to be aware of. And unfortunately, when you do podcasts like this, it's mostly a one-way dissemination of information. But I found when I was going from that second to third floor of the wealth elevator that this your network is your net worth, as they say, right? You got to kind of sometimes pay to play for a community of pre-vetted, purely passive accredited investors.
Why don't you get us to the 4th and 5th floor of the wealth elevator?
4th is sort of known as like the penthouse level, right? Once you're at the penthouse, why even work harder at that point? For some people who want like a hard number, I would just call it maybe $4 to $5 million net worth. Most of my clients are in California. It's pretty expensive out there. But especially if your kids are kind of off to college and, kind of financially on their own, $4 to $5 million at a withdrawal rate of 4 to 5%, which you can get in life insurance whole life. We do the infinite banking, accredited investor banking. Not that you would invest entirely into that, but you could, right? And at 4 to 5% withdrawal rate, tax free, off the table litigators, you could I think that's about like $250,000 of tax-free income every year. So that's I think a key point where once you hit that point, it's not like I mean, I guess you're kind of set for life.
This is when you get into the 4 to 5 million range, or up to 10 million, creating a steady income from yourself from a very low risk type investment that's going to throw off tax-free income like you're talking about.
Right. But if you're in the basement level, first floor, second floor, third floor, do not listen to what we're talking about here, right? Buy the book.
You got to go through floors 1, 2, and 3 before you can get to floor 4.
Exactly. And that's what makes it so hard, right? You hear all these videos out there and it's all like, well, you have to figure out what cattle grade you're at, what floor you're at, and then follow the advice or the teachings for that particular floor. Right. I mean, I'm not going to get into what comes beyond because I don't know if it's pertinent to people listening, and they'll probably confuse the heck out of people. Right. I think people like they may like a common thing, and why I do like individual calls with people is they'll listen to this and be like, oh, I'll do that life insurance thing. Dude, your net worth is 1.25 million. You need to invest in alternatives, right, for more asymmetric returns compared to traditional investments. And you need the tax benefits from real estate. Right? You're not there yet. You're not to that net worth threshold yet.
I still want to hear floor 5 though, even though, people may not be ready for it, but I think we need to open the synapses. So when they are ready for it, they remember that. So what is floor 5?
So essentially when you're at to like 8 figures, right? Which most people who get to $4 or $5 million.
That's a deck of millionaires, 8 figures, like 10 million or more, right?
Yeah. 10 mil, 20 mil, at this point, maybe you're not, you're certainly flying first class everywhere, right? And then it becomes more of a game of people who have read the book Die with Zero, Bill Perkins. I had him on my podcast. Like it's probably like the best book I read last year. But if you're past $1 million or $2 million, great book to read. But it kind of emulates some of those ideals in terms of mindset. But in terms of money and what we talk about in the book, at that point, it's the idea of having your family office grow in the future. Because if you're like $6-7 million and you have a couple kids, you'll probably give each kid $1 million or $3 million, which, side note, I would probably say giving them more than 1.5 would probably any more would be just more detrimental than anything. Yeah. But if you're not giving them like at least a few $1,000,000 or more, it's just not enough critical mass to grow it. Eventually, they'll just disseminate on your third or fourth downline, right? Unless you have them concentrated together, right? So the kids have to actually work together, which is actually like what most people don't recommend. For most people, it's just better to split things off so your kids don't fight with each other, right? But if you wanted to make a run at like, hey, growing into a real family office, getting past $100 million net worth, you have to have the kids work in like a formulated effort to become the business of investing. And that's what, most people, this may not be their thing. They may be totally happy at drifting from $5 to $10 million, but to take it past that threshold, you're going to have, everybody on board in this next generation and even the next one after that.
Some of our listeners might be there already, but I'd say, I guess that a lot of our listeners, are still on floors 1 and 2, but talking about floors 3, 4, and 5 is very important at this point. So you can kind of see to the other side what you should be thinking of, in the future. But Lane, I know you do have to go. I want to make sure you have an opportunity to tell people how they can find out more about you and also plug your book for us.
If this sounds interesting, you guys can go to Amazon, pick up The Wealth Elevator. I would say like the biggest thing is figuring out where you're at right now. I think somewhere in the resources, in the images section of the book, there's like a chart to this. So if you want the cheat sheet, there it is in there. If you guys pick up the book and you email us, team@thewealthelevator.com, we'll also hook you up with the electronic and audiobook version, because I know some people like to read the physical copy and then scan it real quickly and read it 3x speed like that. But check out my podcast, The Wealth Elevator. And yeah, if you guys are on the second, third floor, reach out, lane@thewealthelevator.com.
Your favorite hack or app?
I use ChatGPT for pretty much everything nowadays. Try not to use too many apps. in fact, I guess.
All right. Well, Lane, thanks for coming back on the show. It's been fun talking to you about the wealth elevator and the 5 different floors. Definitely things that, people should be paying attention to, because if you're really going to be successful in real estate, you're speaking to what they should be looking, planning for, even if it's 5-10 years out. So thank you so much for coming on the show today.
Thanks, Brian. Aloha, everybody. See you next time.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. And remember to save the date for the Midwest Real Estate Investor Conference on April 24th and 25th of 2025 in Grand Rapids, Michigan. It's going to be an event you won't want to miss, packed with invaluable sessions and opportunities to connect with like-minded investors. Keep listening for more updates, and we look forward to seeing you there. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.